Germany won the war. That is not the history that was written. But look at the physical record in the autumn of 1918, and the evidence supports it. The Ruhr Valley was intact. The Rhine steel mills were producing. The railway network, which had carried 1.8 million troops to the Western Front, was still operational. Not a single major German city had been bombed. Not one factory had been destroyed by Allied artillery. France had won on paper. Britain had won on paper. But their treasuries were empty. Their countryside was cratered. Their young men were in cemeteries across 5 countries. Germany had lost on paper, but it held something no armistice could take away: the productive capacity that its enemies had spent 4 years trying to destroy. And one other thing: the Reichsbank printing press. And in 1919, no legal framework existed to stop it. The Versailles Settlement imposed 132 billion gold marks in reparations on Germany. Germany's total pre-war gold reserve stood at approximately 2.5 billion gold marks. The gap between those two numbers is not a footnote. It is the entire story that follows. Every German government between 1919 and 1923 understood that the reparations schedule was unpayable in gold. The question they faced, and answered with a printing press, was how to remain solvent while the gap was being negotiated. The paper that kept Germany solvent in 1919 would make it insolvent by 1923. The warning signs were there, all 7 of them, published in real time, in financial newspapers, in government statistics, in the Reichsbank's own printed bulletins. What happened in November 1923 was not a surprise that arrived without warning. It was a conclusion that arrived precisely on schedule. The first warning sign appeared in the Reichsbank's own monthly statistics. The numbers were published. Anyone with a subscription to the bank's bulletin could read them. In January 1921, total currency in circulation in Germany stood at 115 billion marks. By July 1922, it was 252 billion. By November 1922, 497 billion. The mark moved in lockstep. In January 1921, $1 cost 75 marks. By July 1922, the same dollar cost 7,350 marks. 18 months, a trajectory no currency that had ever recovered had ever traced. The Reichsbank's own economists saw it. Internal memoranda from this period, preserved in the Bundesarchiv in Koblenz, noted that domestic credit expansion had developed what one official described as its own internal dynamic. The growth in money supply was no longer tracking reparations obligations. It had exceeded them. The bank was printing for reasons that had moved beyond the original justification. These memos received no formal response. The Finance Ministry files from this period contain no record of a policy meeting convened to address the acceleration. The memoranda were filed. The presses continued. This is the architecture of a financial warning sign. The data is produced by the institution itself. The institution's own analysts name the problem. The institution continues unchanged. The mark at 7,350 per dollar in July 1922 was the first data point the market needed. Most participants chose not to draw the obvious conclusion. Some did. In July 1922, the German government formally requested a moratorium on reparations payments. The request was not made quietly. It was filed with the Reparation Commission in Paris and covered in the German financial press the same week. The Commission rejected it in August. The rejection was published on the front page of the Berliner Tageblatt on August 31, 1922. In December 1922, Germany defaulted on scheduled deliveries of telegraph poles, 200,000 of them, owed to France under the reparations framework. It then defaulted on coal, then timber. Each default was announced in advance, recorded in the Commission's minutes, and published. Raymond Poincaré, the French Prime Minister, had been warning since early 1922 that France would respond to German non-compliance with occupation. He said this publicly, in the Chamber of Deputies, in the French press. On January 5, 1923, Poincaré signed the order. On January 11, 1923, 100,000 French and Belgian troops crossed the Rhine into the Ruhr Valley. By nightfall, they controlled the mines, the railways, and the coking plants. From that morning, Germany controlled neither its primary industrial region nor its credibility with the international reparations system. The external financial world had already issued its verdict on the mark before the troops crossed the bridge. Currency traders in London and New York had been pricing in Ruhr occupation risk since December. The signal was public. It had been public for months. Before we get to what happened inside the Reichsbank in the weeks that followed, because the decision taken in January and February of 1923 was the one that made November of that year not merely possible, but arithmetically guaranteed, it is necessary to understand what the government had now committed to financing. Not with coal, not with gold. The Ruhr was occupied. The gold was gone. With paper. The passive resistance campaign began within days of the occupation. Berlin called on the Ruhr's 2 million workers to stop producing, to cease cooperation with the occupying forces, to strike. The government promised to pay them, all of them, for as long as it took. In March 1923, the Reichsbank's daily print output exceeded the entire monthly average of the previous year. This is not an approximation. It is the figure that appears in the bank's own operational records. The mark moved accordingly. On January 11th, the day the troops crossed, the rate stood at approximately 7,260 marks per dollar. By May, it had reached 47,670. Then came the 18th of May. The date appears in every account of the crisis, and it appears there for a reason. On that day, a single trading session on the Frankfurt Börse, the main German currency exchange, saw the mark's value against the dollar fall by 35%. Currency traders on the floor reported that buy orders disappeared for approximately 4 hours. Not declined, not fell, disappeared. For 4 hours on May 18, 1923, there was no price for the German mark because there was no one willing to buy it at any price. This is known in the German financial record as Schwarzer Freitag, Black Friday. The mark that day was not merely depreciating. For 4 hours, it had ceased to function as an instrument of exchange. One operation in Germany had understood what was coming, not approximately, precisely. Hugo Stinnes had begun acquiring assets in 1919. By the spring of 1923, he held controlling interest in 1,535 enterprises, coal mines, steel mills, shipping lines, newspapers, hotels, and paper mills, including, by some accounts, mills that supplied the Reichsbank with the stock it was printing on. The mechanism was available to anyone who understood it, but Stinnes had built the infrastructure to execute it at scale. Borrow marks from German banks at nominal interest rates. Convert immediately, the same afternoon, sometimes the same hour, into hard assets, machinery, foreign currency holdings, land, real property, anything with intrinsic value independent of the mark. By the time the borrowed marks were due for repayment, monthly inflation had consumed their real value. The debt repaid in depreciated marks cost a fraction of what it had borrowed in real terms. Stinnes was borrowing money and having inflation pay it back. By mid-1923, monthly inflation had reached 40%. The spread between what borrowing cost and what inflation erased made debt a financing instrument more powerful than anything the Frankfurt banks were offering their best clients. By July 1923, the Stinnes operation employed 600,000 people. It was profiled in the German financial press, discussed in the Reichstag, and cited in British Treasury memoranda as an example of how private capital was adapting to the hyperinflationary environment. The structure was inseparable from the inflation that had built it. Every asset Stinnes held was denominated, at its base, in the currency the operation was helping to destroy. It would not survive stabilization. It did not. Hugo Stinnes died in April 1924. The conglomerate began liquidating within months. By 1925, most of the acquired enterprises had been sold, restructured, or dissolved. By April 1923, the inflation had entered what economists who studied it later called the acceleration phase. The mark's depreciation was no longer primarily a financial phenomenon. It had become a logistical one. Berlin factory owners shifted wage payments from fortnightly to weekly in April. By June, from weekly to daily. By August, in facilities with larger workforces, wages were paid in 2 daily installments, half at noon, half at the end of the shift, because the purchasing power lost between morning and evening had become measurable in specific goods. The bread that cost a certain number of marks at 6 in the morning cost measurably more by 6 in the evening. Workers arrived at factory gates with wheelbarrows, not because the notes were physically heavy, because the quantity required had exceeded what a coat pocket could hold. This detail appears in contemporaneous accounts, in factory inspection reports filed with municipal authorities, and in the later testimony of Reichstag deputies who toured industrial facilities in August 1923. It was not apocryphal. It was documented administrative record. At the same time, a second structural problem was reaching its conclusion. Foreign capital that had briefly returned to German sovereign debt in 1921 and early 1922, attracted by high nominal yields and provisional optimism about the reparation schedule, had been exiting since mid-1922. The exit accelerated through 1923. By summer, the Reichsbank's foreign currency reserves had approached what internal documents described as operational minimum. An internal memorandum produced by Deutsche Bank in August 1923, preserved in the bank's historical archive in Frankfurt, summarized the foreign currency situation in a single phrase: structurally irreversible. Not difficult, not challenging, structurally irreversible. The bank's own analysts in August 1923 were not describing a crisis in progress. They were describing one in which the available remedies had already been exhausted. On August 12, 1923, Chancellor Wilhelm Kuno resigned. His proposed stabilization program, spending cuts, tax increases, a formal end to the passive resistance financing, had failed to hold a parliamentary majority. The coalition fractured over the specific terms. Kuno's cabinet had lasted 8 months. Gustav Stresemann took office on August 13th. His coalition was one of the broadest in Weimar history, spanning from the Social Democrats to the German People's Party. He announced within days that passive resistance would end. On September 26, 1923, he issued the formal proclamation. The Ruhr workers would return to the mines. The strike was over. The financial consequences of that decision, 3 years of printing, financed, and then accelerated by months of passive resistance subsidies, had their own internal timetable now. It was no longer synchronized with any political decision in Berlin. The Reichsbank's printing capacity reached its practical operational limits in late October. The machinery had been running at maximum output for weeks. The bank's internal production records note that on November 5th, the daily print run was reduced, not because of a policy decision, but because the presses required maintenance that had been deferred. On November 15th, 1923, the Rentenmark was introduced at a conversion rate of 1 Rentenmark to 1 trillion old marks. By November 20th, the exchange rate of the old mark stood at 4 trillion, 200 billion marks to $1 US. 4 trillion, 200 billion marks per dollar. a number that required notation systems to be redesigned, a number for which the human perceptual system has no evolutionary framework. The Rentenmark stabilized within weeks of its introduction. It did this not because it was backed by gold. It was nominally backed by a mortgage on German agricultural land, a legal fiction that satisfied no rigorous definition of collateral, but because the German government had credibly committed to stop printing. That commitment, that alone, the commitment to stop issuing currency was what made the Rentenmark function. It was precisely what the preceding 4 years had withheld. 7 warning signs. Let me be specific about what that means. Not 7 theoretical indicators that a sophisticated analyst might have inferred from obscure sources. 7 published, documented, contemporaneous data points that appeared in the public record before November 1923. The Reichsbank's acceleration in the bank's own published monthly bulletins. The Reparation Commission's rejection of the German moratorium request. Front page, Berliner Tageblatt, August 31st, 1922. The Ruhr occupation, announced 5 days before it happened by the French Prime Minister in the Chamber of Deputies. Black Friday, reported in the London Times on May 19, 1923, with photographs of the exchange floor. The Stinnes operation, profiled by name in the German financial press, cited in British Treasury memoranda. The twice-daily wage payments, documented in municipal factory inspection records across Berlin and the Rhineland. The Kuno program's failure, published in the Reichstag minutes, covered in every major German newspaper on August 12th and 13th. The pattern these 7 signs traced, emergency financing, dependency formation, acceleration, irreversibility, did not end in November 1923. Britain's departure from the gold standard on September 21, 1931, came after 2 years of publicly visible reserve depletion, a Bank of England report that had warned explicitly about the fragility of the sterling position, and a government that had committed publicly to maintaining the peg. The departure, when it came, surprised almost no one who had been reading the published statistics. On August 15, 1971, Richard Nixon suspended the convertibility of U.S. dollars to gold. He described the measure as temporary. Germany's original departure from the gold standard had occurred on August 4, 1914. That measure had also been described as temporary. Neither description proved accurate. In each successive sovereign debt restructuring of the following decades, Argentina in 2001, Greece in 2010, Lebanon in 2019, the archive record is consistent on one point. The warning signs were documented before the collapse occurred. They were reported in financial newspapers, in central bank bulletins, in IMF staff, reports that are publicly available to any reader today. The collapses did not arrive without warning. They arrived despite it. Germany, in 1923, had an advantage that every subsequent case also possessed. The time between the first visible warning sign and the final collapse was measured not in days, but in years. In Germany's case, approximately 2.5 years elapsed between the mark reaching 75 per dollar and 4.2 trillion per dollar. 2.5 years of published data, of public debate, of documented institutional analysis that named the problem and received no formal response. The question the archives leave open is not whether the signals were visible. They were visible. They were printed, in some cases, by the same institution producing the currency that was collapsing. The question is what it would have taken to act on them. Whether the people who read the Reichsbank bulletins in 1922 and understood what the numbers meant were the same people who had the authority to change the policy. Whether the authority and the understanding ever occupied the same room at the same time. The record on that question is less clear. And it is, in fact, the only genuine historical mystery the Weimar hyperinflation leaves unresolved. 7 signs. Printed in real time. The collapse that followed was not hidden in the archive. It was announced by it.